Welcome to the Money Huddle, a podcast that explores financial topics for families and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Planners Alliance. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Planners Alliance may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with Ross Marinell. And I think Ross has got a fun little story to tell us this morning.
I do. Michael, how you doing today?
Doing well, buddy. How are you?
Doing awesome. So
I'm getting old, though.
Yeah. You just had a birthday, right?
Just had a birthday, so the joints are creaking a little louder right now.
I don't want to hear it.
Yeah.
So I found this article from, as we know, if you follow golf, right, the majors have kicked in, and we had the Masters a few weeks ago.
The Masters is pretty amazing. That is like one golf tournament that I legitimately want to watch every year. I can't say that for any of the others, but the Masters, I'm tuned in.
If you care about golf, you're watching the Masters.
No doubt.
And so this year, something quite astonishing happened, which is after many, many years, Tiger Woods came back and won the Masters.
It was phenomenal.
What a comeback from where he was just a few years ago. And something kind of popped up from that, which was there was a gentleman named James Aducci, who placed a wager on Tiger Woods to win the Masters, cashing out an $85,000 bet at 14-1 odds and won $1.19 million.
So he bet $85,000.
He bet $85,000 that Tiger Woods was going to win the Masters.
Oh wow!
And he was right. Now this is unbelievable. He claims that's his first wager he's ever placed.
Wow.
That's his first ever sports bet.
Like a Hail Mary when it comes to gambling. It's like the first bet he's ever made in his entire life, he's going to bet $85,000.
Bet $85,000 for Tiger Woods.
Who hurt you, James? Who hurt you?
I tell you.
That's like he was committing financial suicide and it just backfired on him in the best possible way.
So this is where the story takes a little bit of a turn. So this past week, the golf just had the PGA Championship. And
right.
Apparently, this same guy had bet $100,000, so now $100,000.
Oh yeah,
that Tiger would win the Grand Slam at 100-1 odds. So meaning he's going to win all 4 major tournaments this year. And of course, as it happens,
he's playing with house money.
Tiger didn't make the cut.
No.
So you can't win if you're not playing on Saturday and Sunday.
Right.
So
wow.
That was a crash and burn bet. But could you imagine?
$100,000 evaporated in the thin air.
So we talk quite a bit about behavioral finance and managing one's biases and emotions, which happens to everybody.
It's the key.
Professional investors, retail investors, we have to understand our own biases,
right,
and how it affects our decision making. And a couple of the behavioral biases we talk about is overconfidence,
no doubt,
and recency bias.
We see that.
So we rung the bell on both of these.
Yeah, no question. Wow. So he wins 1.1 million,
1.19 million.
Okay, and then he, obviously we got to pay tax on that, so he didn't get to keep that.
That's right. So you got to pay tax on that money. So you're going to lose a decent little chunk there to Uncle Sam.
Okay, so we know he's gonna pay tax, so he didn't get to keep the full amount, and then he turns around and he makes an even more improbable bet with $100,000.
Right. In my theory, could you imagine the overconfidence you would have in yourself, your ability to win gambling bets if the first sports wager you ever make nets you a 14-1 winner and you're now, at least on gross income, a millionaire?
Oh, I know. Wow.
And I can't imagine, then
can't tell me nothing.
Right. Yeah. And then to come back and then to lose $100,000 when after tax you may have netted, I don't know, $800,000-$900,000, somewhere in that range, a lot of money to somebody who's, you may not be accustomed to having that much income and that much net worth, to now all of a sudden have, let's say, $800,000 or $900,000 in after tax money.
Right.
And the next thing we're going to do is gamble
He was
over
going
10% of that.
He was going for retirement. He was like, you know what? I'm going to retire. I'm going to retire big after Tiger Woods gets his Grand Slam. I'm going to be hanging out with Warren Buffett and Bill Gates.
But what a test case for just
at 100-1 odds,
bias.
at $100,000. What is that?
Oh, I mean, he would have won $10 million.
I was going to say
yeah.
$10 million, right?
Yeah, but he didn't. But he lost $100,000. So
Oh, well.
He's still up big. Hopefully, this will be a nice.
He's still got a 50%
lesson
success
to
rate.
That maybe for the rest of that, several $100,000, put that to good use.
I'm still good for 50%.
Whew.
You know, you bet 50%. You bet 500. You're in the Hall of Fame for sure, right?
Well, what a test case for
question.
behavioral bias. And so when we talk about investing and stock market investing in particular, we tend to look at the recent activities and extrapolate those out and think that the things that have happened recently are more common and more likely to happen in the future, and maybe give more credence to what happened in the last, let's say, 30, 60, 90 days, maybe even a year, versus looking back at a more realistic time frame.
Sure.
To calculate our returns and our odds of success.
Well, yeah, I mean, it's, right now, if we look, today is, we're in the middle of 2019, May 2019. And, 10 years ago in March, the Great Recession, the financial crisis, the market bottomed in March 2009. So you had all these articles come out not that long ago that was saying, 10-year anniversary. And pretty much for the last 10 years, the market has been on this upward march.
Right.
And I'm specifically referring to U.S. equities as an asset class. Generally have, if you were investing in U.S. equities and you started, 10 years ago, you haven't seen any real scary things happen. Yes, there's been some times where we've had corrections and we've had, brief, drops down where, you could technically say it was a bear market, but not a protracted or prolonged, 2 years of just taking grenades. Right. And what worries me now is I think a lot of people are kind of getting lulled into, this is just what it is. This is how investing is. And not remembering that sometimes the market can turn very severely and eliminate a lot of wealth. And so if you look back at a lot of fund performance now, a lot of people are very excited about their trailing 10-year returns because, the market, everyone's going from like the bottom now. Started from the bottom, right, and now they're at peak levels.
I've been clicking around a website. I'm going to give you this name. It's called DQYDJ. Don't quit your day job. So that's the acronym.
That's the website.
DQYDJ.com. It's got some interactive charting in it.
Oh, I get you. I'm with you.
Yeah.
I hear where you're going.
So this is a way, get a little bit of extra information, take a look back at some of the historical performance. And so on that note, I've been clicking around a little bit and I just pulled up their chart on the S&P 500, looked at starting in May of 2009 through May of 2019, and calculating an annualized return of just under 14%. So looking at about 13.966. So you're in that for 10-year period of about 14%.
Right.
That's pretty astonishing.
Gotcha.
Now, take it back 5 more years. Just roll it back to 2004, May. Recalculate. It's still good, but it's now a more modest 8.194% return.
And this is just purely index.
Just S&P 500 historical price return from May of 2004 to May of this year.
Gotcha.
Now, that is probably in people's realm of being a little bit more realistic annualized return for S&P 500, but take it back 5 more years. Take it back to May of 1999.
Yeah.
So now we've got a 20-year history.
Right. 20
Right?
years.
We've had a couple of different cycles, couple of drawdowns.
Yeah.
Now that annualized return, it's 5.338.
Sad.
So just think that's just a 20-year window versus a 15 versus a 10. The 10 looks wonderful, double-digit returns. Like you mentioned, there have been very few instances where it's been maybe treacherous drawdowns. But then you expand it out just 10 years, and it's a completely different story.
How it changes. Yeah. No, absolutely. And I think that's great information to segue, because I know I told you one of the things I wanted to talk about today was just, and I'll term it this way, or at least open it up this way. You know, I was reading some things on LinkedIn last week, and, you know, people nowadays are just, we're bombarded with information sludge from all different angles. You know, I mean, I know from financial stuff, like we read a lot more heavily, you know, financial news, financial media, and I feel like there are days when I'm just being waterboarded with content, and a lot of it is, it's like half research. It's just, can we get content out, like push it out?
Right.
How quickly and how much volume can we dump on people? And and I realize the game is, because the game is now is, you know, people are going more and more and more online for, you know, to research information. So there's all these advertising, there's, you know, how much content you can generate, and with keyword searches and all that, you know, pulls your websites to the forefront. So, you know, if you got a website like CNBC where you got the tickers, I mean, that's the site I typically go to see, you know, the market index tickers and stuff. You know, all those articles that are just constantly on there to try and draw eyeballs. And it's just there are really good quality content producers out there, but most of these mainstream websites, it's just bunk. And what's happened is, as a result of that, is we see more and more, it's like, it's just human nature, right? The more complex it is, we try to distill things down to simple. It's like rules of thumb. And so that's where these, like, you know, these rules of thumb just kind of come up and they stick with people. Right. And I had a friend of mine say to me the other day, who was working with someone, and he said, you know, well, they just tell me, like, you know, average 12%. And I'm like, huh? You know? Right. And then I realized, like, you know, I've heard that before. Right. And I go into, and I'm like, who's done? And sure enough, you know, these, like Susie Orman is one that constantly talks about, you know, just average 12%. And Dave Ramsey's another, was like, just average 12%. And I'm like, wait a minute. Like, if it was just that easy, then why are we not all like multimillionaires? And so, you know, that's kind of like what got me thinking about, like, you know, this. And anyway, I did some digging, and this is what's crazy is I took 2 minutes and did a Google search, like just debunkery, right? Right. You know, what's this return? So literally in 2 minutes, I find an article on CNBC.com, and and we'll include the links to all the articles and stuff in the show on the webpage and on the notes. But it says here that the average annualized total return. So this article was written, just for reference, it was written in June of 2017. So almost 2 years ago, right? Mm-hmm. We know that 2018 was not a great year, so it would not necessarily have improved the data, you know, markedly at all. And 2019 is still up in the air, but it says here, the averaged annualized total return for the S&P 500 over the past 90 years is 9.8%. Right. So for the last 90 years, what have we had happen? We had the Industrial Revolution in the country. We had civil rights. We had women's right to vote. We had, like, unbelievable advances in technology. Right. We had all kinds of stuff happen. All of these things, you know, you could argue to be very we win the Cold War.
Health, life expectancy.
Exactly.
Everything.
Positive on top of positive on top of positive. And the S&P has averaged, which would be a phenomenal average, by the way, 9.8%. And yet you still have folks out there telling people that they should just expect a 12% rate of return.
Right, and that
It's
falls back
unbelievable.
to if we're analyzing a too small of a period of time, then we can get a little overconfident. We can feel a little bit too assured that this is what the future is going to hold. When we pull it back a little bit further, and you pull in some of those downturns and the financial crisis to the .com crash, and then you get a very different story. But from their perspective, they want to create an argument, right, to be more frugal with your spending. So don't invest, don't buy the coffee, save that money. It's like the $4 a day we spend on coffee. If we put that into a savings account and grow it at 12%, and you look 10 years down the road, that's a lot of a more startling number than if you said, well, what if we only got 4% or 5%?
Sure. Well, I think there's a couple things at work. Number one is with the internet and with the information, like I said, the sludge age that we live in now, you can literally, if you have a Wi-Fi connection, a laptop, and you could do a Google search, you can create a blog where you just spew out information left and right. That doesn't make you a financial expert. All right. And a lot of these folks that give like generalized rules of thumb do not have securities licenses. And so to me, and the way that I know that Ramsey specifically, they get around this a lot is they give very general educational and air quotes, advice, but they always say, well, we want to introduce you to a financial professional. We want to introduce you to a financial professional. And never mind that the financial professionals they're going to introduce you to are at least the last time I looked into it, they were paying his enterprise a fee for the referrals, to be sent to. So there's a business model at play there, and that's fine. But it's the people that are saying it, they don't have a license to sell securities. Could you imagine if we were sitting here telling people, oh, well, we could just average 12%? The regulators would be at our door, wanting, hey, well, give us your testing, give us your proof, give us your, all these different things, how you've consistently done, had that performance. And, like we just shared is like the 90-year average on the S&P is, less than 10%. So I think that's part of it. And the other part of it is when it comes to saving and investing, I think you do people a disservice when you try to entice them to save by promising them like pie in the sky. Like, oh, no, the real reason you should be saving is because your money can grow. Because what you're doing is you're kind of in a roundabout way, you're appealing to people's greed. Do you agree?
Well, yeah. I mean, going back to how we started this conversation today, which was we have a gambler who placing his first bet wins 14 times his money, and can't imagine the overconfidence and self, just confidence he probably has in his own ability to make these kind of decisions. When, the reality is if you look back at the S&P 500 over a 10-year period of time, then the results are going to show really wonderful returns in that, 12, 13% range. You expand it back and it just changes the story. And people should have a little, more grounded belief or understanding of what can happen.
Oh, for sure.
Meaning there are periods where you could have enormous returns, and there's also periods where you could have really disastrous, painful, hard to stomach losses. And the test of success, a lot of times, is being able to stick to your investing strategy through the worst periods of time, if not even add to your investments during those periods of time.
Yeah.
And so the conversation, if it's like, well, just average 12% return. Well, that sounds wonderful. Who wouldn't want to do that? What it should say is, well, there may be periods where you have a 30% return and periods where you have a 40% loss. Can you stick through that investment cycle when things are really bad and you're seeing your account balances drop and there's pain and anguish? It's sort of like, sure, you win, bet $85,000 to win $1.1 million on Tiger Woods, but then the next week you turn around and lose $100,000.
Right.
That's.
Well, I think we both can agree, and I would imagine we probably could get unanimous consent from financial professionals that that's not an investment strategy. He was extremely lucky, but to that point, what happens is the good thing is that if someone does start down a path for investing and saving, we want them to stick on it. But what's hard is the behavioral component. And so if you've entered into investing thinking that, you're going to average a 12% rate of return, and you don't see that, then, do you start to itch and say, well, no, I'm going to move my money out? Because we all know that markets have cycles. There are good years, and there are bad years, and there are flat years. And sometimes, we get into, there are good decades and not so good decades and flat decades. And so what I think is more important is to understand, that, it's human nature to want to cherry pick our, the returns that you want to focus on, like, kind of confirmation bias. Like if you think, well, the market's just going to go up, then you tend to gravitate towards information that's going to bolster that belief. Likewise, one of the other things we see very common is financial folks trying to scare the life out of people about investing in the markets because there is volatility, and they get into, stuff that they have no business investing in. Right. And so it's like it can work both ways. And I think the appropriate way to look at it is, first of all, like, do you have a personal financial plan for yourself? Right. If you need to save money, like, well, okay, what does your budget look like? Is there any margin in that budget for you to actually save? What's our priority here? Is our priority here to get debts paid off? Is it to, save money for college or save money for retirement? And create your own plan and your own system so that you can work that system, right? I don't know. What's the main idea here? I mean, I think that first of all is, if you gamble, don't do that. But B, or, hey, if I know people that'll place a little tiny, wager on sports every once in a while. Just be responsible with it. First of all, don't put any money out there that you can't afford to lose. And for heaven's sakes, if you have a windfall like this guy had, if you do something like that where you make $1 million, that's life changing. Don't go right back to the casino. No. Like make yourself set up, use it to the maximum ability you can.
And don't go right back to the casino with a 100-to-1 bet.
Oh my heavens. Well, that's how he might really have been telling the truth. It was his first bet ever. So then, I guess the second thing is that there's, we do now live in an age of just tons and tons of information coming at you from all angles. So I think it's more important than ever that you find some trusted resources. I can't recommend enough, finding a competent financial planning professional, someone that has a CFP, someone that's, got credentials, that's been in the industry, that you feel you can relate to, that's trustworthy, that can help you, just discern fact from fiction, because there's a lot of stuff that gets put out on the internet. And I hate to say it, I know a lot of people believe this, but if it's on the internet, it doesn't mean it's true, especially when it comes to financial advice, because there are so many differing opinions and thought processes to go into different information. So, and I guess the topic of the day for when it comes to that was this mythical 12% per year or 12% average return unicorn that some financial gurus just continue to pump out there.
I just think when we're looking at a household budget, you're looking at how much is coming in, where it's going out. You're making choices on where do we cut, where do we pinch some pennies, right? To say, all right, what's some of the unnecessary things we spend money on? It doesn't have to be a comparison against a 12% return stock portfolio.
It shouldn't be.
Sometimes just it could be a much more realistic return calculation or assumption, and the choice is still probably, all right, let's save the money, even if it's growing at a more historical long-term return versus something that we're just sort of looking at the last 10 years and saying, well, we'll get this forever. Even if it's just a regular rate of return, single digit, it's fine. It doesn't have to be a comparison against, one of the best 10-year periods we've had.
Yeah, no question. So, as always, if you're looking at trying to get your personal finances in order, cannot recommend enough getting yourself an actual plan to get started. Like, for example, I just started working with a personal trainer. And I'm a former athlete, so I've never had a trainer ever. I've done CrossFit classes. I've been to, Orange Theory with my wife. I've done workout classes at the YMCA. I've played all kinds of sports. I've never had a trainer because up until, probably the last 6-7 years of my life, I was always in better shape than most of the trainers I saw. So I was like, okay, what are they going to teach me, right? And so now I get started, and what is the first thing he wants me to do? He's like, okay, here's our system, here's our plan. And we built out this plan for me now on like how I'm going to eat and like what types of foods I'm going to eat and what, when I can treat myself and not treat myself. And it's basically creating a system. It's creating a health plan for myself. And so you should do the exact same thing for your finances, even more, because financial is so easy to get emotionally, mixed up when it comes to money. So if you've got a plan that you feel confident in, you just work your plan and stick to it, and you can ignore a lot of the garbage that gets put at you every single day.
I agree 100% with that.
Awesome. Well, thank you so much for listening. If you got any questions or topics you'd love for us to chat about here on the show, give us an email. Our email is themoneyhuddle@vcplanning.com. We're also on Facebook. Give our page a like. You can contact us through there as well. And we'll talk to you next time.